Have you ever wondered why you make certain trading decisions? What's really happening in your mind when you buy or sell? Today, we're going to uncover the secrets of behavioral economics and how it affects your bottom line. Welcome to our channel, the place where you learn to trade smarter, not harder. Now, if you're like most traders, you probably like to think of yourself as a rational, logical person. But when it comes to money, things get a little messy. Enter behavioral economics, the study of how psychological factors influence our economic decisions. Spoiler alert, it's not pretty. Let's start with one of the most common biases that wreck your trades: fear of missing out, or FOMO. When everyone around you is making money in the market, it can be tempting to jump on the bandwagon and buy at the top. But that's exactly what the herd mentality does. And we all know how that story ends. Then there's loss aversion. We tend to hold on to losing stocks for too long, hoping they'll rebound, right? But sometimes it's best to cut your losses and move on. Behavioral economics suggests that we feel the pain of a loss twice as intensely as the pleasure of an equivalent gain. That's why we get emotionally attached to our investments and refuse to sell even when it makes sense to do so. But it gets worse with confirmation bias and anchoring. Once you have an initial belief about a stock or market, you tend to ignore any new information that contradicts it. Anchoring is the tendency to rely heavily on the first piece of information you come across, even if it's irrelevant. So if a stock is trading below its 50-day moving average, you might be anchored to that number and see it as a buying opportunity, even if the company's fundamentals have changed since then. The bottom line, the market is driven by collective sentiment, not just supply and demand or economic indicators. When everyone is optimistic, prices go up. When fear takes over, prices go down. You've heard of bubbles and crashes, right? Well, they're classic examples of group psychology in action. A bubble occurs when investors buy into a stock or asset because of its potential for quick profits, even if it's overvalued. When the music stops playing, so to speak, and the new buyers dry up, the bubble bursts and prices crash. The dot-com bubble of the late 1990s and the housing bubble of the 2000s are prime examples of this. In fact, market crashes are so predictable that economist Robert J. Shiller dubbed it irrational exuberance. People get caught up in the excitement of a rising market and buy into it just because they fear missing out. Then, when prices start to fall, panic sets in and everyone wants to sell. But don't worry, there are ways to outsmart your brain. Create a trading plan and stick to it. This is your emotional firewall. Diversify and manage your risks. Don't put all your eggs in one basket. Keep a trading journal to track your wins and losses and learn from your mistakes. Most importantly, be mindful of your thoughts and emotions when trading. Observe them without judgment and ask yourself, are you letting your ego get the better of you? Remember, it's not personal, it's business. So keep learning, keep growing, and keep mastering your financial mindset. With time and practice, you'll become a more disciplined and profitable trader. Thanks for watching. Hit the like button for more insightful trading content. Stay tuned for our next video, and happy trading!